Hey there, investors. Oh man, did you see the market on Monday? It was a sea of red out there. The Dow Jones, the S&P 500, even the tech-heavy NASDAQ, everything took a serious tumble. We're talking about the kind of drop that makes even the most seasoned investors break a sweat. So, what in the world happened? Why did the market decide to throw this massive tantrum? Well, folks, it wasn't just one thing. It was a perfect storm of worries that all seemed to hit at once. Think of it like this. The market was already feeling a little under the weather, and then, bam! A whole bunch of bad news came along and knocked it right on its back. We're talking economic jitters, the Fed's next move, and even some whispers about corporate earnings not being as rosy as we thought. Now, I know what you're thinking, Jim, is this the big one? Is the market crashing down around us? Hold your horses, because it's not time to panic just yet. But it is time to understand what's going on, and more importantly, what it means for your hard-earned money. So buckle up, because we're about to dive deep into the wild world of Monday's market mayhem. One of the biggest factors weighing on the market right now is the Federal Reserve, aka the Fed. These guys are like the referees of the economy, trying to keep everything fair and balanced. Their main tool? Interest rates. When they raise rates, it's like tapping the brakes on the economy. When they lower them, it's like stepping on the gas. Right now, the Fed is stuck between a rock and a hard place. Inflation is still hotter than a firecracker, which makes them want to keep raising rates. But raising rates too much could tip the economy into a recession. It's a delicate balancing act, and investors are getting nervous. The Fed is trying to walk this tightrope between fighting inflation and avoiding a recession. It's not just the big picture stuff like the Fed and the economy that's got investors spooked. There are also whispers about trouble brewing in the world of corporate earnings. See, companies have been raking it in for the past few years, posting record profits left and right. But now, some analysts are starting to wonder if the good times are coming to an end. Why the sudden pessimism? Well, for starters, the strong dollar is making it harder for American companies to sell their goods overseas. On top of that, higher interest rates mean it's more expensive for businesses to borrow money, which could eat into their profits. Now, I'm not saying that earnings season is going to be a complete disaster, but even if things aren't as bad as some fear, the mere possibility of an earnings slowdown is enough to make investors hit the sell button. Remember, the market hates uncertainty more than anything, and right now, there's a whole lot of uncertainty swirling around the corporate world. Section 4. Global Jitters. Add to the mix. As if things weren't complicated enough, we've also got some international drama adding to the market's woes. Remember that whole carry trade thing? That's where investors borrow money in a country with low interest rates, like Japan, and then invested in a country with higher rates to make a profit. Well, the Bank of Japan recently decided to tweak its monetary policy, and let's just say it didn't sit well with the carry trade crowd. They started pulling their money out, which sent shockwaves through the global financial system. It's like someone pulled a thread on a sweater, and now the whole thing is unraveling. And don't even get me started on the geopolitical risks. We've got the ongoing war in Ukraine, tensions between China and Taiwan, and who knows what else brewing under the surface. These situations are like ticking time bombs, and any one of them could explode and send the market into a tailspin. Section 5. Keeping a cool head in a turbulent market. Okay, so we've covered a lot of ground here, and it probably sounds pretty darn scary. But before you run for the hills and sell everything you own, take a deep breath and remember one thing. Corrections happen. In fact, they're a perfectly normal part of the market cycle. This is a correction, not a panic, says market veteran John Belton. The economy is still strong, and there are plenty of reasons to be optimistic about the future. Michael Farr, another seasoned investor, agrees. It's important to stay focused on the long term, he says. Don't let short-term volatility derail your investment strategy. So, what's the takeaway here? First and foremost, don't panic. Second, stay informed. Keep an eye on the news, read up on the issues, and talk to your financial advisor. And finally, remember that while the market can be a wild ride, it's all part of the game. Stay informed, stay invested, and as always, stay bullish.